You're sitting on a financial time bomb, and you don't even realize it. As you read this, trillions of dollars are silently migrating from the hands of people like you to the hands of those who understand what is happening right now. And I need to tell you something that will hurt. You are probably making at least one of the three mistakes that I saw destroy fortunes in 1987, in 2001, in 2008, and which are about to destroy wealth again in 2026. I spent 45 years building Bridgewater Associates, managing more than $160 billion through 4 major crises. And there is a pattern that repeats itself with mathematical precision. 93% of investors make the same 3 fatal mistakes every time cycles change. And 2026 will be a cycle-changing year. The first mistake has already cost individual investors $4.2 trillion in the last decade alone. The second error is so subtle that even sophisticated investors fall for it, losing an average of 38% of their wealth when they realize it. The third mistake is the most brutal because you think you are protecting yourself when in fact you are exposing yourself to the biggest risk of your life. I'm going to show you exactly what these 3 mistakes are, why you're probably making at least one of them right now, and what you need to do in the next few weeks before it's too late. And if you're not yet subscribed to the channel, subscribe now because what I'm going to share in the coming weeks could be the difference between preserving and losing your heritage in the coming years. And that's not an exaggeration. It's a historical pattern that has been repeated for decades. The first fatal error that I need to reveal to you is what I call the illusion of diversification. And I guarantee you that you are making it right now without knowing it. You think you're diversified because you have 60% in stocks and 40% in bonds, right? Or maybe you are more sophisticated and have 20% in American stocks, 15% in international stocks, 10% in small caps, 5% in emerging markets, 30% in government bonds, 15% in corporate bonds, and 5% in REITs. Sound diverse? Let me show you the brutal mathematics that will destroy this illusion. In 2008, when the market collapsed, do you know how many of these assets fell together? All. American stocks fell 56%. International stocks fell 51%. Small caps fell 61%. Emerging markets plummeted 63%. REITs collapsed 68%. And even corporate bonds fell 23%. Their diversification lost an average of 48% of its value. Why? Because you weren't diversified across sources of return. You were diversified across asset names that all responded to the same factor: risk appetite. At Bridgewater, we developed the all-weather portfolio concept based on a simple truth that most ignore. True diversification is not about having many different assets. It is about having assets that react differently to the 4 possible economic environments: growth accelerating, growth slowing down, inflation rising, inflation falling. Each of these environments destroys certain assets and favors others. If you don't have balanced exposure to the 4, you're not diversified. You're just diluted with diversification. And here's the specific mistake you're making now. You're overexposed to the accelerating growth environment with controlled inflation, exactly the environment that dominated from 2001 to 2021. Your 60% in stocks perform well when growth accelerates and inflation is low. Your 40% in bonds performs well when growth slows and inflation falls. But do you know what happens if we have stagflation like in the 70s? Growth slowing with inflation rising? Both your stocks and bonds collapse together. That's exactly what happened in 2022 when the traditional 60-40 portfolio had its worst performance in 47 years, falling 18%. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because this era of false diversification is global. And I want to understand how many people in different parts of the world are falling into the same trap that I saw destroy assets in 4 decades of career. Let me tell you the story of an investor I met in 2007. I'll call him Robert because he requested anonymity, but the story is absolutely true. Robert had built a net worth of $2,400,000 over 23 years working as an executive at a technology company. He was the type of investor that the financial industry loves. Disciplined, contributed regularly, rebalanced annually, followed all the rules. His portfolio was diversified according to traditional standards. 55% in stocks, diversified by geography and sector. 35% in bonds of different durations and qualities. 10% in REITs. In September of 2007, I was at a conference and had the opportunity to speak with Robert briefly. He proudly showed me his portfolio and said he was confident because it was completely diversified against any crisis. I looked at him and said something he didn't want to hear. Robert, you have no real diversification. You have correlation masquerading as diversification. If we have a credit crisis, you will lose between 40 and 50% of that equity because everything you have collapses together when credit dries up. He politely disagreed, cited his financial advisor, mentioned efficient frontier theory, and continued confidently. 18 months later, in March of 2009, Robert had lost $1,086,000. 53% of the equity that took 23 years to build evaporated in 18 months. He called me devastated. Do you know what hurt him the most? It wasn't the loss itself. It was discovering that your advisor had lost exactly the same percentage because he used the same false diversification approach. Robert had to postpone retirement for 7 years. This mistake literally cost him 7 years of his life working instead of enjoying what he built. And here's the part that worries me most about 2026. I'm seeing the same pattern of false confidence in traditional diversification that I saw in 2026. People look at their statements, see 15 or 20 different positions, and sleep peacefully, thinking they are protected. But when I analyze the actual correlation between these assets in different economic environments, I see that 83% of the risk is concentrated in just one factor: economic growth. If growth slows abruptly, especially with persistent inflation, these portfolios will collapse just as they collapsed in 2008. The math of cycles doesn't lie. When corporate debt is at 186% of GDP as it is now, when credit spreads are compressed to 2007 levels, when systemic leverage is at historic highs, you cannot afford to have illusory diversification. You need real diversification through truly uncorrelated sources of return. The second fatal error I need to expose is even more insidious because you probably think you're doing the right thing. This is what I call emotional timing disguised as strategy. Here's how it works. You decide you're going to wait for a correction, to buy more shares because the market is too expensive. Or you decide to take profits because everything is too high. Or you read some worrying news about the economy and decide to temporarily reduce exposure until things become clearer. Each of these decisions seems rational, seems strategic, seems prudent, but mathematically, it's pure emotional timing, and emotional timing has a proven cost of 38% return over 20 years. Let me show you the data that proves this. Dalio carries out an annual study called Quantitative Analysis of Investor Behavior that compares the return of the average investor with the return of indices. From 1994 to 2023, the S&P 500 returned 9.8% per year. Do you know how much the average equity fund investor earned in the same period? 6.3% per year. A difference of 3.5% per year doesn't seem like much, right? But compounded over 29 years, $1 million invested in the index became $13.7 million. The same million with the average investor's return became $6.1 million. You lost $7.6 million, 55% of what you could have had, simply because you tried to time it. And why does this happen? Because emotional timing has a predictable pattern. You sell after the market has already fallen, when fear is at its peak, and you buy after the market has already risen, when greed is at its peak. You think you are being prudent, but you are systematically buying high and selling low. At Bridgewater, we have developed what we call the pure alpha approach to separate views on markets from exposure to risk factors. When we see that markets are going to fall, we don't sell everything and go to cash. That would be emotional timing. Instead, we use derivatives to express the view while maintaining balanced exposure to long-term risk factors. Why? Because we admit humility. We can be wrong about timing. We can be wrong about magnitude. We can be right about direction, but wrong about when. And the cost of being wrong about timing is devastating. In 1999, some of the smartest traders I knew thought technology stocks were ridiculously expensive. They were right, of course, but they sold in 1998, missed the 86% rise from 98 to 99, and went bust before the bubble burst. Being right about direction doesn't matter if you're wrong about timing. Now let me tell you the most brutal story about emotional timing that I have personally witnessed. In October 2088, during the height of the financial crisis, I was in a meeting with institutional investors. The market had fallen 42% since October of 2007. Lehman had failed 5 weeks earlier. The panic was absolute. Institutions that managed billions were discussing whether to sell everything and go into treasury bonds because the financial system could completely collapse. Dritzi, I presented our analysis showing that valuations were at the cheapest levels in 25 years, that the probability of total systemic failure was less than 15% based on analysis of the Fed's actions, and that historically, maximum panic buying has always generated returns of 50 to 100% over the next 3 years. Do you know how many had the courage to buy? Less than 5% of the room. Most sold or remained in cash. From October 2008 to March 2011, 30 months later, the market rose 102%. Those who sold in the panic lost double their money. But the story gets worse. These same institutions, after missing the 102% rise, finally returned to stocks in 2012 and 2013, when the market had already completely recovered. They bought high after selling low, exactly the opposite of what they should be doing. This error cost the beneficiaries of these funds, real people depending on this money for retirement, literally hundreds of billions of dollars in lost returns. And here's what scares me about 2026. I'm seeing the opposite pattern happening now. People are so confident after years of the market rising that they think they can time the next correction. They will wait for clear signs of crisis to sell. But clear signs only appear after the crisis has already begun. When all the signs are clear, you have already lost 30 to 40%. Then fear comes, you sell at the bottom, and miss the recovery. It's the same film, just the cast changes. The mathematics of emotional timing is brutal and proven. Studies show that investors who attempt timing lose an average of 2.5% per year in return, and professional timing professionals, with all the resources and analysis, have a success rate of just 47%, worse than flipping coins. You won't beat this math. Nobody wins. The third fatal mistake is the most dangerous because you think you are being conservative when in fact you are taking the biggest risk of your financial life. This is what I call false security in cash and short bonds. Here's how it happens. You see uncertainty in the market, read about recession risks, get worried about valuations, and decide that the prudent decision is to stay in cash or short-term bonds until things get clearer. Sounds safe, right? Zero volatility, no chance of nominally losing money. You can sleep peacefully. But here's the brutal mathematical truth that no one tells you. In environments of persistent inflation, cash is the riskiest asset there is because you are absolutely certain of losing purchasing power. It is not a risk of loss, it is a guarantee of loss. Let me show you the math that proves this. From 2021 to 2023, 3 years, accumulated inflation in the United States was 18.2%. If you had $100,000 in cash in January of 2021, in December of 2023, you still had $100,000 nominally. But the real purchasing power was $81,800. You lost $18,200 of purchasing power with absolute certainty while you slept thinking you were safe. Now compare with someone who maintained exposure to real assets, such as commodities, real estate, and shares of companies with pricing power. This person had volatility, had sleepless nights, but preserved purchasing power. Who was really safer? The person with short-term volatility but long-term preservation of value, or the person with nominal stability but guaranteed destruction of real value? At Bridgewater, we define risk differently than traditional industry. Risk is not volatility. Risk is the probability of not achieving your financial goals. If your objective is to preserve purchasing power and be able to buy a house, pay for your children's college education, or retire with a certain standard of living, then cash in an inflationary environment is the riskiest asset, not the safest. You are guaranteeing that you will not achieve your goals. And here's what makes me genuinely worried looking ahead to 2026. Millions of investors are sitting in cash and money market funds thinking they're safe while they wait for the right time to invest. But while they wait, the persistent inflation I see in the structural data is eroding 5 to 6% a year of real purchasing power. In 5 years, these investors will discover that they have lost 28% of purchasing power, hoping for safety. Let me tell you the story that struck me most about this mistake. In 1979, I met a gentleman named Arthur who had retired in 1973 with $400,000 in savings, a fortune at the time. Arthur had lived through the Great Depression as a child and was terrified of the stock market. He swore he would never put his money in paper that could turn to dust overnight. So he kept everything in savings accounts and CDs, paying 6 to 7% a year. It felt safe. It seemed prudent. The problem is that from 1973 to 1981, 8 years, accumulated inflation was 103%. Prices more than doubled. Arthur's $400,000 generated another $56,000 in interest, so he had $456,000 nominally. But in real purchasing power, adjusted for inflation, he had the equivalent of $224,000 from 1973. He lost $176,000 in real value, 44% of his assets, remaining safe in cash. When he finally understood what had happened in 1981, Arthur was 82 years old and had neither the time nor the health to recover. He spent the last 12 years of his life at a much lower standard of living than he planned, not because he took risks and lost, but because he avoided nominal risk and suffered guaranteed real loss. This story taught me something that has become one of my core principles. What seems safe in the short term is often riskiest in the long term, and what seems risky in the short term, like stocks of solid companies or real assets, is often safest in the long term because it preserves purchasing power. And here's the death trap I see forming for 2026. After years of low inflation from 2001 to 2020, an entire generation of investors did not experience persistent inflation. They have no visceral memory of how inflation destroys cash, so when they see uncertainty, the instinct is to go cash. But the structural data I analyze shows that we have entered a different regime. Deglobalization is increasing costs, energy transition is increasing costs, population aging is increasing costs, debt degrowth will eventually be inflationary. The probability of us having average inflation of 4 to 6% for the next 5 to 10 years is greater than the probability of us returning to 2% inflation. In this environment, staying in cash is not prudence, it is financial suicide in slow motion. Now, I know exactly what's going through your head, because I've heard these objections hundreds of times. The first objection is, "But Ray, isn't it better to wait until you're sure before you act? Why would I risk my money if I'm not sure what's going to happen?" And here's the brutal truth you need to accept. Absolute certainty only comes after the event has already happened. And by the time you know for sure, it's already too late to act. In October of 2007, you weren't sure a crisis was coming. He only knew for sure in September 2008 when Lehman went bankrupt. But by then, the market had already fallen 25%. If you waited for certainty to sell, you sold close to the bottom. If you waited for certainty to buy back, you bought after the 50% recovery. Waiting for certainty guarantees that you will buy high and sell low. The game is not about certainty, it is about probability and preparation. You don't need to be sure a crisis is coming to protect against it. You just need to recognize that the probability has increased enough to justify protection. It's like insurance. You don't need to be sure that your house will catch fire to have fire insurance. You just need to recognize that the risk exists and the cost of the insurance is less than the potential cost of the disaster. The second objection I always hear is, "But implementing these changes in my portfolio will generate taxes and costs. Isn't it better to leave it alone?" And here's the math that destroys that objection. Yes, rebalancing your 60-40 portfolio for true diversification can trigger 15 to 20% capital gains taxes. It hurts to pay that. But if you don't, and we have a crisis that drops your portfolio by 45%, like in 2008, you will lose much more than 15% in taxes. You will lose 45% of everything. And worse, you will lose at the worst possible moment when you don't have time to recover. The cost of acting preventively seems high until you compare it to the cost of not acting when the crisis comes. Paying 15% in taxes now to avoid a 45% loss later is not a cost. It is a bargain. The third objection is the most dangerous. "But I'm young, I have time, I can wait for the crisis and buy cheap later. Why protect now?" Here's what this objection ignores. Market timing matters tremendously for compounding returns. If you have $1 million at 30 and lose 50% in a crisis at 35, you are left with 500,000. Even earning 10% a year for the next 30 years until 65, you end up with 8.7 million. But if you hedge and lose just 20%, leaving you with 800,000, and earn the same 10% a year, you end up with $14 million. The difference of 30% more loss in the crisis turns into $5.3 million less in retirement 30 years later. Composition brutally amplifies errors. Protecting assets in crises is not about being old and conservative. It is about compounding mathematics for any age. So here is the binary choice you face now. with no middle ground possible. Option A. You recognize that you are making at least one of these three fatal mistakes, probably two, maybe all three. You admit that your diversification is illusory, that your emotional timing is costing you returns, that your false cash security is destroying purchasing power. You act in the coming weeks to correct this. Build true diversification across the four economic environments. Eliminate tentative timing and systematic rebalancing, and replace cash with assets that preserve real purchasing power. It will hurt to act. It will generate taxes. It will require effort. It will be uncomfortable to change what you have always done. But the cost of acting now is temporary and limited. Option B. You ignore everything I've shown you, keep doing what you've always done, because it's more comfortable. Wait for the signs to become clearer before changing something, and hope you're among the 7% who won't be destroyed when the cycle turns. If you choose option B, and I'm right about the patterns I'm seeing, you will lose 35 to 50% of your wealth over the next 18 to 36 months. Not because he is unlucky, but because he made the same three mistakes that destroyed 93% of investors in all previous crises. And the cost of this is permanent. It's not money you can get back quickly. It's a decade or more of extra work. It's postponed retirement. It's a reduced standard of living. It's the college your kids won't be able to afford. It's the legacy you won't leave. There is no option C where you stay quiet, and everything works out because 2026 is different from all other crises. Cycles don't work like that. The economic machine doesn't care about your desires, and if this content alerted you to risks that you weren't seeing, leave a like now because this helps the algorithm take this message to more people who need to protect themselves. And if you are not yet registered, sign up and activate the bell, because in the next videos I will break down each of these protection strategies in detail that could make the difference between preserving or losing your assets in the next crisis that historical data tells me is closer than most imagine. I spent 45 years building systems to navigate exactly these moments where cycles are turning, and most don't see it. We sailed 1987 when we lost, but learned principles that saved us later. We sailed 2000 when the tech bubble burst. We sailed 2008 when the financial system almost collapsed, and Bridgewater was one of the few funds that had a positive return. We sailed 2020 when the pandemic stopped the world. Each crisis has taught that preparation trumps prediction, that principles trump predictions, and that protecting assets before a crisis is infinitely cheaper than trying to recover them afterwards. The three fatal mistakes I showed you destroy heritage iOS because they are invisible until it's too late. False diversification seems prudent until everything falls together. Emotional timing seems rational until you realize you bought high and sold low. Cash seems safe until inflation devours half the purchasing power. And what worries me looking at the data from 2026 is not whether we're going to have volatility, it's how many people are going to find out too late that they were making these mistakes. Economic cycles don't care if you are prepared or not. Crises don't wait for you to feel comfortable to act. History proves that those who act too soon regret it for weeks, but those who act too late regret it for decades. Choose your weeks of regret now or your decades of regret later.